Boredom in financial decision-making. In financial markets, most investors experience emotional reactions such as fear or greed. However, boredom is less discussed. Boredom in investing may arise when a stock moves sideways for a long time. There is no excitement or volatility. The investor feels emotionally unstimulated. Research in behavioral finance shows that boredom can influence decision-making just as strongly as fear. Psychologist Daniel Kahneman demonstrated that people rely on emotional shortcuts rather than rational analysis. Boredom may reduce engagement, leading to passive holding behavior. 3. Psychological mechanisms behind not selling. 1. Decision fatigue. Choosing whether to sell requires cognitive effort. Over time, investors may avoid making decisions simply because they are mentally tired. This concept is closely related to cognitive load theory and has been studied in decision psychology. 2. Status quo bias. People prefer to keep things as they are rather than make changes. The concept of status quo bias was explored by Richard Thaler, a pioneer in behavioral economics. Investors may hold assets not out of belief, but because changing feels unnecessary. 3. Emotional avoidance. Sometimes boredom masks deeper emotions. Fear of making a mistake. Fear of regret. Uncertainty about alternatives. Rather than actively evaluating the asset, the investor disengages. 4. 2 possible outcomes. Positive outcome. Accidental discipline. In some cases, not selling out of boredom may lead to long-term holding. Avoidance of impulsive trading. Benefiting from compound growth. This resembles passive investing strategies that reduce emotional trading errors. Negative outcome. Passive neglect. However, it may also lead to ignoring deteriorating fundamentals. Missing better opportunities. Emotional detachment from financial responsibility. The difference lies in whether the decision is strategic or unconscious. 5. Boredom versus patience. It is important to distinguish boredom patience, emotional disengagement, intentional waiting, no active reasoning, strategic reasoning, avoidance discipline, passive controlled. Patience is an active psychological choice. Boredom is often passive withdrawal. 6. Market psychology and stimulation. Modern financial markets are highly stimulating environments. News, volatility, and social media create constant excitement. When stimulation decreases, boredom increases. Behavioral economists argue that investors sometimes trade not for profit, but for stimulation. Conversely, when bored, they may either trade impulsively to feel excitement or avoid decisions entirely. Both reactions are emotional, not rational. 7. The hidden emotional narrative. The one who didn't sell because they were bored may actually represent emotional exhaustion, loss of engagement, avoidance of responsibility, subconscious hope. The financial decision becomes secondary to the psychological state. 8. Conclusion. Not selling because of boredom reveals an important truth. Financial decisions are rarely purely financial. They are shaped by cognitive energy, emotional regulation, biases, motivation. Boredom can accidentally create long-term success or silently cause missed opportunities. The key question is, was the holding a strategy or simply emotional withdrawal?